This video is intended to supplement the notes on financial ratio analysis used in my managerial finance class and my intermediate accounting 1 class at Faulkner University. This is created in the fall of 2018. In course notes, of course, we've described what financial ratio analysis is as one of the most commonly applied techniques in analyzing a company's financial performance and position using financial statement data. And in the notes, we identified 5 basic categories of ratios, that is, areas of concern that the ratios tell us something about or inform us about. Liquidity ratios, asset management ratios, profitability, debt management, and shareholder return ratios. I'll not try to repeat the discussion or the introduction of that material and the coverage of the ratios, because this video really is intended to explain a particular application in those notes. In that set of notes, you were given or provided a multiple step income statement and a balance sheet in fairly simple form for a fictional company called Delux Drugs. And in those notes, you were to calculate the ratios for, or at least to confirm the ratios for Delux Drugs using that financial statement information, and the notes which showed how to calculate each of the ratios required. And you were also given industry ratios for comparative purposes. There's the Delux Drugs ratios and the retail drug industry ratios. I also showed how to do what I call the quick analysis to compare Delux Drugs ratios to the retail drug industry, and if Delux Drugs ratios fall outside an acceptable range around the drug industry's ratios, then we have to identify those as either falling outside in a bad direction or a good one. If it falls within the acceptable range, we just assign a value or a designation of neutral to that. So the quick analysis is our starting point here, where we have calculated the company's ratios, compared them to a standard, and then done what I call the quick analysis. So we've identified each of those as G, B, or N, good, bad, or neutral, relative to the industry average. The next thing we need to do is sort of put these pieces together to evaluate the firm's financial position and performance relative to, in this case, the industry average. Now here's how we're going to do it. For each ratio, we're going to identify, first of all, the ratio category that it falls into. And then by category, we will evaluate Deluxe's position and performance by identifying the ratios that fall into that category or that address that category. Explain what the quick analysis revealed about that firm's position and performance, and then conclude with an overall statement of evaluation that addresses the main question that the ratio category seeks to answer. So for liquidity, for instance, liquidity ratios in this example, there were only 2 of them, the current ratio and the quick ratio. Liquidity, hopefully you'll recall from the notes, concerns the company's ability to pay its bills on time. And so here's how we might use those ratios to compose an evaluation of Deluxe's liquidity. Although the current ratio is in line with the industry average, the quick ratio is well below the industry average, indicating the company may have difficulty paying its bills as they come due. Of course, this is always, we have to keep in mind, relative to the standard, in this case relative to the industry. Now notice the current ratio was classified as neutral in the quick analysis. So that ratio was in line with or comparable to the industry average. But the quick ratio is a more conservative measure of liquidity, and it was below the industry average, or we might say it was inferior to or poor with respect to the industry average. And so notice here we've got one ratio that says, well, things are okay, and the other ratio that says, no, they're not okay. And I encourage you to come down in a more conservative position, or your conclusion is going to, in this case, to come down a more conservative or pessimistic view, to say that although the current ratio is okay or comparable to the industry average, the quick ratio is poor, and therefore the company could have difficulty paying its bills on time. Notice we're not saying it will, because we don't have that much information. These ratios only compare balance sheet amounts, and so they say here's the position the relative position of current assets to current liabilities, or quick assets to current liabilities at a point in time. But relative to the industry average, this company is not in as good a position to pay its bills on time. Let's move on to asset management. There are three major categories of assets, or I should say the three major categories of assets or classes of assets in the balance sheet are going to be receivables, inventories, and PP&E, or fixed assets. And by major, I mean that those really generally account for the lion's share of investment compared to any others. And so we have, not surprisingly, three ratios: average collection period, that pertains to receivables; inventory turnover, inventory; and fixed asset turnover, that pertains to PP&E, or fixed assets. Now notice here we have total asset turnover that's really a composite. It's an overall. And it's important to me that you note that, and that in fact we'll say total asset turnover is going to give us the overall, or represent the overall composite measure of asset management. Now asset management really is about concerned with determining if the company is generating sufficient sales from its assets. So the evaluation might look like this: although the average collection period is better or superior to the industry average, better than the industry average, the inventory turnover and fixed asset turnover ratios are worse. They are inferior to, they are below the industry average. Overall, the total asset turnover is well below the industry average, and here's your conclusion, indicating the company is not generating sufficient sales relative to its assets. Now you might have, in this case, you've got the average collection period that's good, but the other ones, inventory turn and fixed asset turn, are poor. Someone might ask, what happens if all these other these average collection period, inventory turn, fixed asset turn, what if those are good and the total asset turnover is bad? Well, you've probably made a math error someplace, because the total asset turnover is just a composite. It's the big picture. It's the overall measure. And that, for our purposes, needs to be listed last, and it needs to, for the most part, your conclusion is going to reference the total asset turnover. The others tell part of the picture, but the total asset turnover is the overall. And again, asset management ratios are really concerned with the company's ability to generate sales from assets. So notice we're building a case here that although one measure was good, the others were poor. So I'm going to go ahead, like any attorney in court would. If you've got information or evidence contrary to your client's position, you don't avoid that, and let your opposition make the most of it. You go ahead and mention it and more or less dismiss that. And then you build your case for your conclusion. So if you've got a piece of information like we have here that's contrary to the overall conclusion, go ahead and put that first and get it out of the way. Note the proper format. Identify the ratios relevant to the category. Tell what the quick analysis revealed about those ratios, and then conclude with a statement of evaluation. All in complete sentences. That's important to me. Profitability. Now here we've got the number of ratios. There are probably more profitability ratios than any others. So you've got several in this particular problem, but not a lot. You've got the ROE, net profit margin, and ROA that are mentioned in this problem, or that are required to address in this problem. Notice ROE, return on equity, does double duty as a profitability ratio, but also as a shareholder return ratio. We'll see it again in just a moment. So anyway, the ROE is neutral with respect to the industry average. It's comparable to it or competitive, but the net profit margin and ROA, return on assets, are below average. So that's the direction we're going to end up. So we say again, the ROE is in line with the industry average, but the net profit margin and ROA are below average. They are poor relative to the average. They are inferior compared to the industry average. See, I'm trying to give you some alternative phrasing here. There's not a magic set of words, but obviously there's some that are more concise and more to the point and correct than others. And part of what I want to test you on and have you do is, can you apply this technique properly? So here's our conclusion then. We note the ratios, we explain what the quick analysis revealed, and so the result is, the conclusion is, the company is not generating sufficient profits from sales or assets. Now notice really what we're doing is comparing either income statement amounts like net profit margin to sales, or we're comparing some measure of profitability to some measure of investment. In this case, net profit, or to sales. Net profit margin is net profit over sales. Those are both income statement amounts. The ROA is net income over total assets. So net income is income statement amount, or assets, of course, from the balance sheet. And so really we could say the company did not, since we're looking at the past some measures of sales or profits, but it's probably as understandable and concise to say the company is not generating sufficient profits from sales or assets. So anyway, there's I think would represent, in my view, a good response to for profitability. Debt management. There are really two kinds of debt management ratios. One category is debt usage ratios. That includes the debt ratio, debt to equity ratio, the equity multiplier. And then another, what are called coverage, sometimes called coverage ratios, in this case the times interest earned. So the times interest earned is okay, but again the debt ratio is too high, or high relative to the industry average. So we're going to come down on the more conservative side. Although the times interest earned ratio is in line with the industry average, the debt ratio is above the industry average, indicating the company may be using too much debt financing, or we might say the company may be too reliant on fixed cost debt financing. Notice here that there are two really types of ratios that where lower is better than higher. For most of the ratios we deal with, higher is better than lower. The average collection period. Lower is better than higher, because the higher that measure is, the longer it's taking you to recover, your cash from your credit customers. So we want to get money all else the same, faster rather than slower. And here, the debt ratio, or the debt usage ratios that include the debt ratio, debt to equity, and equity multiplier, we prefer those to be lower rather than higher, because too high a debt ratio can really hinder the company's ability to, it indicates the company has low financial slack or financial flexibility. And we talk more about that in class, but let me move on with this one. So again, we've got times interest earned. That's one of those ratios that says, hey, things are okay here. But we've got another ratio that says, no, things are not okay. The debt ratio is too high. So we're going to come down on the conservative side and say these imply that the company may be too reliant on debt financing. Finally, shareholder return. The only ratio we've got here in this problem is the return on equity. We know that that's already we've determined that's neutral. It's in line with the industry average. So being the only ratio that we have that pertains to shareholder returns in this problem, then the only thing I can say is to conclude that the firm is earning an adequate return on shareholders' investments. Notice the language of in line or comparable, of neutral, is to say the firm is earning an adequate or sufficient or competitive return, or a return comparable to that of its peers. The language that's the language of neutral: comparable, in line with, adequate, sufficient. The language of good is going to be superior, exceptional, good, above average in most cases. The language of poor is going to be poor, or inferior to, or inadequate, bad, that sort of thing. So, you need to think about what the language of good and bad is, because you wouldn't want to say here that the firm is doing well or is earning a good return on its shareholders' investment. The language of neutral is competitive, not good. That brings us to the end of this particular example.